Cost behavior analysis. Now, this is a study on how specific costs change or respond to changes in the level of activity within a business. Some costs will change, some costs will not change. Understanding how cost behaves really helps management when they're faced with making a decision, and when they're making a decision they have different courses of action. Each course of action may have different costs. They have to know how the cost would change if the activity level related to that cost increases. Now, there are two types of costs. There's variable costs and fixed costs. Variable costs change in total in direct proportion to changes in the level of activity. If the activity increases 10%, the total variable cost will go up 10%. If the activity decreases by 25%, the total will decrease. Let's assume I'm manufacturing a desk and I'm looking at the cost of wood. Now, I say to myself, if I produce one desk and the cost of wood is 50, if I produce two desks, the cost of wood would be 100. The activity doubled and the cost doubled. If I produce 10 desks, the cost of wood would be 500. The activity went up 10 times and the cost went up 10 times. So we'd say that the cost of wood is a variable cost in total because it changes with activity. But it remains the same on a per unit basis. It's always 50. So make sure when you're discussing variable cost, whether you're talking variable cost as a total cost or as a unit cost. Now contrast that with fixed. Fixed costs remain the same regardless of changes in the activity level. However, the unit cost varies. That is, it goes down. If I produce this desk in a factory and the factory costs me $10,000 rent a month, I produce one desk, the rent is $10,000 per desk. If I produce two desks, then the rent is $5,000 per desk. If I produce 10 desks, the rent then is $1,000 per desk. So it varies inversely with activity. As activity goes up, the cost per unit goes down. When we talk about fixed costs, we have to keep in mind what is referred to as relevant range. That is, I have this factory that can produce 1,000, up to 1,000 desks, and therefore the fixed cost will remain the same for the 1,000. But once I start producing beyond 1,000, I have to add fixed costs. So the relevant range is from 0 to 1,000. Now there are some costs that change, therefore they are variable, but they don't change in direct proportion. They're not fixed because they change. So a mixed cost is a cost that has both a fixed and a variable element to it. And we have to break it out into the fixed portion and the variable portion. And what we do is we use what's called a high-low method. That is, we look at the difference in costs at the high and at the low. Now the difference in that cost is the variable portion of the cost, because the fixed cost would remain the same. Let's go through an example. Here we have Harris Company accumulates the following data concerning mixed cost using miles as the activity level. So in January they drove 10,000 miles, it cost 17,000. February they drove 8,000 and it's 13. Well, you can see that his costs are changing, but they're not doubling, they're not changing in proportion to activity. So what we do in the high-low is we take the change in activity over the change of cost. We take both. So therefore, what we need for the high-low method is the change in cost over the change in activity. Now we take the high activity, 10,000, so therefore at 10,000, so the high and the low activity is 7,000. High cost is 17,000, and the high cost, or the low cost, is 12,500. The cost at the low activity. So therefore, the change in cost is $4,500 for a change in activity of 3,000 miles. So that equals $1.50 per mile. And that's our variable cost. Now, we then go back and we take it at the high. The total cost was $17,000. And the variable cost would be $10,000 times 1.5, which in this case would be $15,000. So if the variable cost is 15, then the fixed cost would be $2,000. And if that's the case, it would be the same at the low. At the low, the total cost was $12,500. The variable cost would be $7,500 times 1.5, which would be $10,500, and their fixed cost, of course, would be the same at that level. So the fixed is always fixed, So we can say that if we wanted to predict the cost, y equal a plus bx. Alright, a is the fixed cost plus b is the variable cost times the activity. And so for this one, the fixed cost would be, so y would equal 2,000, we can predict the activity, plus 1.5 times x. Jesus. Sorry about that, it would be x. So if I wanted to figure out what it would be at 11,000, it would be 2,000 times 1.5 times 11,000. So that's how we break a mixed cost out. Now, cost volume profit analysis is a very important in profit planning, and it's a critical factor in managing decisions. We're going to look at how costs change in relation to volume and the effect that has on profit. And we come up with what's called a contribution margin. That is the amount of revenue after deducting costs. So we take the costs and we format the sales minus variable cost equal the contribution margin. So in break-even analysis is the process of finding that break-even point at which total revenues equal total cost. And we use the contribution margin to do that, and we can do it in both sales units or sales dollars. Now keep in mind the contribution margin is the total revenue minus the total variable cost. Break-even point is that point where the contribution margin equals the fixed cost. So for example here, I have a selling price of 25 and I have variable cost of 15, contribution margin of 10. Therefore, my contribution margin per unit is that. My contribution margin ratio, if I put sales at 100%, my variable costs are 60, my contribution margin ratio is 40. So with that, and I have fixed costs of 100,000, I simply, the break-even point in dollars is the fixed cost of 100,000 divided through by 0.4, the contribution margin ratio, and I get 250 as the break-even in dollars. The break-even in costs in units would be the 100,000 divided by $10, or 1,000 units is the break-even. Well, you see it's the same thing. 1,000 units at $25 is 250,000. So I calculate the break-even both in dollars and in units. Well, two more things. Target net income. Well, instead of just doing a break-even, all we have to do is take the fixed cost plus the target net income and divide it through by the contribution margin per unit, or contribution margin percentage. And that will give us in either sales units or sales dollars. If I use contribution margin per unit, I get my answer in units. If I use percentage, I get my answer in dollars. And that will tell me how much I have to sell, not only to cover my fixed costs, but give me a targeted net income. Lastly, the margin of safety. Now that is the cushion. That is the difference between the actual or expected sales and what I need to break even. It's referred to as a cushion, and it's a measure of the risk of a company. So if a company has selling 1,400 units and it needs 1,000 to break even, then it has a margin of safety of 400 units. Compare that to another company that maybe has the same break even, 1,000, but it's only selling 1,100 units at the current time. It would have a margin of safety of only 1. And there you have the cost, volume, profit.